Okay, welcome to this lecture on business. So today we will be looking at cost behavior analysis. So first off, I just want to start by looking at costs versus investments. So here, costs are expenses involved with being in business, and investments are capital expenditures that are expected to produce future revenues. Normally, one-time outflows are investments, and costs are usually continually expended. So now moving on here to categorizing a cost. So there are different ways to categorize a cost, and these are the four displayed here. So first off, we'll look at fixed costs. And also, just keep in mind, items must be measurable if they want to be categorized as a cost, and the item should have a strong influence on the level of costs incurred by the firm. So now, moving on to fixed costs, these are costs that do not change despite changes in volume. Now, variable costs, these are costs that change directly and proportionally with changes in volume. Step costs are costs that change with parts that are fixed and variable. They are costs incurred in large chunks. For example, you can produce 300 units with 3 workers, but if you want to produce 301 units, you need 4 workers. It consists of a base cost level, regardless of volume, and then a component that increases linearly as volume increases. So now moving on to semi-variable costs. These costs consist of a base amount which is always incurred, regardless of the volume level, plus a component which increases linearly as volume increases. And all the graphs shown on this page here have a y-axis of profit and an x-axis of volume. So these are the kind of arrangements that these graphs take on. So as you can see, fixed cost has a horizontal relationship between these two variables, and variable cost has a linear relationship, etc. So now, how do we create models with this information? Well, when creating models to relate revenues, costs, and profit to the various activity levels, we break down each cost into variable and fixed components. So also note, variable costs and fixed costs depend on time. A fixed cost could be a variable cost if the rate it changed was more frequent. In the long run, all costs are variable. For example, if a company is in business for 20 years, the monthly fixed cost payments begin to look variable. If time periods are short, it is also logical to say all variable costs become fixed costs for the same reason. Now, other assumptions to these models include the relationship between costs and volume is perfectly linear, which it never is, but we can get pretty close with a linear relationship. The cost structure is formulated in a context of certain external conditions, and they do not change. So now moving on, I'm going to look at an example because I think an example is a good way to bring all of this information in, because there are a lot of formulas and a lot of information to understand for actually making business decisions, which I hope that through all this and at the end of the lecture you will be able to make financial calculations for businesses. So this is the business we will be looking at today. So as you can see, we have wages here, we have loans, advertising, renting a car, ladders, soap, and miscellaneous. And so this business is a window cleaning business. It'll be running for 4 months. And each job that this company completes will give them $300. So, looking at wages here, the employees will be paid $1,000 per month plus 5% commissions on door-to-door cold calling sales that turn into becoming actual jobs. There's a loan here of $5,000 with 5% interest per month. We have advertising costs here of $100 per month. A car is being rented for $1,125 per month. And if need to hold more people or ladders, it'll move on to $1,500 a month. Ladders here are $1,000, and carrying value at the end is $200. So at the end of the 4 months, these ladders will be worth approximately $200. Soap and other costs during the job will come to about $10 per job. And yes, 4 months of business and $300 per job is what we are expecting to get. So now moving on here, all I have done is I've categorized all of these costs into the fixed costs, variable costs, step costs, and semi-variable costs. I would say this is probably the most important part of cost behavior analysis, and this will allow you to do a lot of things. So it's very important to get this right and make sure you understand where all these costs go. So here, fixed costs, $250 per month from this loan, and that's coming from this area here. It's 0.05 times $5,000 per month. It's 5%. That comes to $250 per month. And also $200 worth of depreciation on the ladders comes in as a fixed cost, and that is $1,000 minus the carrying value here, giving $800. $800 divided by 4 months equals $200. And also $100 worth of advertising comes in as another fixed cost. Now here we're looking at variable costs. We have soap and miscellaneous costs at each job, and that comes to $10 per job. We have step costs. That's our rental car because it starts at $1,125 per month, but may become $1,500 per month if we need more ladders or more employees. And also semi-variable costs. That comes with monthly salary of $500 per month and $15 per commission on each job sale. So here all I did was, as I said, when creating models to relate revenues, costs, and profit to the various activity levels, we break down each cost into variable and fixed components. So as you can see, we have total fixed costs and variable costs. And all I've done is broken down within each group what we have and what it comes to. So as you can see, all these coming together comes to $4,675 in total fixed costs, and variable costs come to $25. And here, revenue, as we know, is $300 per job. Now moving on here, I just want to show you a sneak peek of the different equations that can be used with cost behavior analysis. If you write all these down, take a minute, pause the video, and take all these down, you will be able to make most financial calculations that will be needed to understand how a business is doing and make your decisions regarding the business. Okay, so here I'm going to be doing some calculations just to figure out just to get a better gauge on monthly unit sales for this company. So I will be looking at a low estimate of monthly sales, medium, and high. Now I'm going to be looking at volume. I'm going to be looking at unit contribution. Going to be looking at total contribution. Fixed costs. And profit. Okay, so let's say a low monthly volume estimate would be 50 customers per month. And we'll say a medium estimate is 80 customers per month. And we'll say a high estimate is 120 customers per month. unit contribution can be calculated with the page of equations that I've shown before, and it is simply selling price minus unit variable cost. That would be $300 minus $25, as shown on the previous page that I showed. So that would come to $275 in each case. Now, we'll look at total contribution, which is simply unit contribution multiplied by volume, and that will give us 1,300, or 13,750, sorry. Here it will give us 22,000, and here we will come up to $33,000. Fixed cost we realized from before is 4,675. And we will tally these up and figure out what the profit is in a low, medium, and high setting for volume each month for this company. So profit here would be 9,075, 17,328, and 2,800, or 28,325. Okay, so looking at those profits, we can realize here that in a high situation, we'd make $28,325 worth of profit, and in a low situation, we'd make $9,750, or $9,075. So we can judge risk in this case, and we can make a fairly confident decision that we will end up between these two numbers. If we are satisfied between these two numbers of profit, then this may be a good investment, and it might be a good idea to run this company, or continue running this company, etc. But first, I just want to make sure that you understand what unit contribution and total contribution are, so that you understand where these things are coming from. So unit contribution is simply the amount from each job, in this case, that is kind of surplus value that can go back into the company, that can be used to pay off fixed costs. It can be used and re-inputted into the company to expand and get bigger and become a stronger force in the economy. Now, total contribution is all of these simple unit contributions multiplied by volume. So that just means that it's all of these unit contributions, so every single sale, the surplus on every single sale, coming together, and that's total contribution. So now I just wanted to take a look here. This is a simple graph that I created, just showing the calculations that I put in before with you guys. So here series 1 is just simply revenue, and series 2 is total variable cost. So as you can see, they are both slightly linear relationships, and this just shows the difference between revenue and total variable cost. So you can see that we are making, if we go along with this business plan, we will be making a lot more profit than we will be losing from the costs. This area here between the blue and the orange line is total contribution, which I was talking about before. Also note, our break-even point is around this area here, probably at about a sales volume of 15 units. Okay, so now I'm just going to go over a few calculations that can be easily used to understand the business's position and make decisions from there on. So here we will start off with zero profit break-even point. So that is equivalent to total fixed costs over selling price minus unit variable cost, which is also equivalent to unit contribution. So this equals here. This would be our fixed costs, which was shown in the previous slide, of 4,675 over 275 of our unit contribution, which brings us to 17 units per month to break even. And this is actually interesting because, as I showed previously from our graph that I created, it looked to be around 15 units, which is very close, which means that all these calculations are proving to be true. Now, the next equation that I'm going to look at here is contribution margin ratio. Margin ratio. Now, this is equivalent to unit contribution over selling price. So that equals unit contribution of 275 as shown before, and each job is worth $300. This comes to 0.9167. So this ratio is just showing the ratio from unit contribution to selling price. So on each job, what amount of the profit can be used to be put back into the company. So this can be used to pay off fixed costs, etc. Okay, now moving on to break-even volume. For zero cash flow. And that's equal to total cash fixed costs over unit contribution, and that equals the $100 from advertising plus $250 from the loan over 275 unit contribution, and that gives us 1.3 units per month. So 1.3 units per month is needed to break even for zero cash flow. Okay, so now moving on to the next equation that I have here. Okay, so this one is going to be target volume for target profit. And that is going to be equivalent to total fixed cost plus target profit. Plus target profit all over unit contribution. Okay, so that will come to 4,675 plus, let's say our target profit each month to bring us to $30,000. That's what we'll say our target profit is, over 275, and that will give us 126 units. 126 units are needed for $30,000 in profit every month. Okay, so those are some interesting equations that you guys can use to evaluate businesses and understand them better. Now, the last point I want to make today is just the point that income statement formats can change based on the contribution basis. So I just want to show you a little example of this. So we know that for the company, we will have an income statement here, and it will have net sales, it will have less cost of goods sold, gross profit, less operating expenses, and net profit. Now there is also another case where we can get net sales less total variable costs, total contribution, less total fixed costs, and net profit. So all I want to show you here is that it is possible to account in these two different ways here. And this side shows on the cost behavior analysis basis, and this one shows on the regular accounting basis. Thanks for watching.